Welcome, everybody, to the ARMR Report. This is the in-game update. It's Friday, 3 o'clock at the end of a very strong Risk Monitor Green week. Now, normally I would be doing a live stream tomorrow at 11:30, but I'm off the desk tomorrow. Can't do it. So I thought I'd share this with all of you. And of course, ARMR Insiders, you got questions, feel free to fill up the Slack room, and I'll answer questions right at the end of these thoughts. So a couple of things. Quick message, right? Risk Monitor Green. It means that it's time for us to put capital to work. That happened at the end of last week. So we spent this whole week putting capital to work. I want to share with you some thoughts after the SNAP earnings, the Honeywell earnings, some things I'm starting to hear that are making me change the complexion of my portfolio and how I go about investing as we go forward into this risk-on market environment. So I'm going to get to that in a minute. Don't forget, this is about the ARMR Investing Way. It's really a process that I use to run my own capital. I've been doing this over 30 years, blah, blah, blah. You guys know all this, but I'm just sharing it for anybody who's new. So it's a three-stage process, right? We build our whiteboard of fundamental ideas. We use algorithms that I provide for you, the ARMR proprietary algos for when we add or subtract capital. Which stocks we buy using algorithms, which groups we're focused on using algorithms. That's what we do here, right? And then we use stop losses to protect ourselves. So that's the process. You got to do your own due diligence. You're the only one that knows your risk tolerance, so you can't necessarily listen to this conversation or any conversation, quite frankly, without looking in the mirror and saying, can I handle this risk? Should I handle this risk? Okay, so I'll leave that up to you. But I'm going to share my experience, and hopefully you can grow from it with me. So step one, we had a little bit of a shakeout today in the market after the SNAP earnings last night. So let's just talk about them for a second. Let's look at the market while we do. So the first thing I wanted to say is this is our day trading screens that we use to, for lack of a better term, we scalp the indexes as often as we can using the ARMR algorithm, the price movement profiler, and spot gamma locations. When we get those two things together, we like to trade. So I'll go over that in a minute. But I just wanted to share with you the S&P on a weekly level. S&P's down about 0.1%. Okay. So all the hysteria and shenanigans this morning and concerns that maybe this is going to change some type of a buy signal, it hasn't done anything today. And instead, what we have, and the most important thing for any new risk on entry point, is the weekly bar chart, the weekly chart, not just the daily, because we're talking about investing now. We're not talking about day trading. We're saying, what's the investing climate? And so what that's telling you is 3 strong up bars in a row, bang, bang, bang on a weekly level. There's your risk on entry point at the end of last week. So we captured, this move up in the indexes, right? And we're looking for the market to continue to go higher in the coming weeks, okay? Until a stop is broken. And there's no stop even close on the index. So step one, bull market buy signal is in effect. Nothing has changed that even with the SNAP news. Now let's go look at SNAP for a second, okay? So here you have this, gap down, what are we down? 25, 26%. Which is now an island reversal, really just ugly on SNAP. Here are the takeaways from the conference call that I think really matter. The most important takeaway from the conference call, and let's look at it like that. You can see the chart there, okay? So how does this affect the broader market is what everyone's trying to figure out right now. SNAP said 2 things on the call. Number one, that iOS changes from Apple ruined their business. So everyone's dumping Facebook, Twitter, whatever, anything that has to do with maybe the problem SNAP is having. Number 2, they talked about the supply chain issues and labor shortages and even shipping issues. All of that led to SNAP's, earnings miss. So let's just fillet this for a second. First of all, the iOS issue. It could be an issue for everybody, but it's specifically an issue for a business that's like 100% mobile, which is what Snap is. Okay. So to think that it's going to have the same impact on Twitter and Facebook, which is not 100% mobile, I think is a mistake. The street's probably saying, well, even if it's not as big of a miss as Snap, it could affect these other companies. So why would we add risk into earnings when risk is elevated because of what Snap just told us? So how's Twitter going to blow out the number if they're having the same problems that Snap's having? In which case, who needs to own it in front of the number? We can always just buy it after the number. That, I think, is what's going on here. But should it tell us that all of these names are going to drop huge because of Snap? I don't think so. I think it's specifically a Snap issue because of its 100% mobility situation, number one. And number two, because they didn't come up with, as a management team, and I'm sorry to say this, please don't take offense, Snap, and your management team, but you didn't come up with measures to protect yourself. Everybody knew the iOS changes were coming through. Okay. And so what you did was trust Apple with what the changes were going to be and hope that Apple would do the right thing. And apparently it stumbled. So it doesn't mean every management team's done the same thing. I'll give you an example. Levi's, one of my favorite stocks to own right now. Okay. Okay. So here's Levi's, tight pattern. Now, if you listen to the last conference call of Levi's, so there it is coming out across the tops, pulls back right on tops, right? And had a fantastic quarter. So why am I showing you Levi's? All right. So what I'm trying to say is, here's a story about a company that makes products all over the world and has to have them shipped into the US or wherever they're shipped. So they have the same issues that Snap claims that their customers have, right? Snap doesn't have these issues, but their customers who advertise on Snap have the issues. Okay. So this is a question of management teams. Management teams that are really good can see into the future, okay, and are always managing risk and setting up support for their systems that they can fail safe to if a system goes wrong. That's what we're paying the big bucks to the management team for, right? So in the case of as like a case study on Levi's, if you listen to that last conference call, analysts were shocked. Like, how are you guys delivering in the midst of these labor shortages, COVID shutdowns? Vietnam shuts down. You have a lot of manufacturing in Vietnam. How did that not affect you? And what they said is, look, guys, we have built in place manufacturing facilities all over the world, and we order more or less from a different locality, depending on what's going on from a macro environment. Brilliant, right? So if Vietnam is shut down, they're able to jack up their demand from, who knows, somewhere in South America. Bang, they can fill orders. Another question was, well, how are you getting into the country? Because, West Coast is shut down. They said, guys, we could see the West Coast was having a problem. So we increase our orders from countries or manufacturing facilities that will deliver to East Coast ports. I mean, this isn't rocket science, but you do have to think ahead and you do have to set up the right business model. Levi's done it. Snap didn't do it. Snap is suffering. Okay. So, on one hand, I think it's a lot of Snap issues that put the stock down. On the other hand, I can see why you're getting sell-offs in all these other names, because it doesn't pay to own them in front of earnings now, right? Because now there's a hurdle. And I have no doubt there'll be some companies that blow out the number and the stocks are up huge. I mean, it could be Twitter. People will be like, what? It was just a Snap problem and Twitter stock will be up huge on earnings. But who's willing to take that risk, at least today, when you see that story? Okay. So that's what's happening. The other question that I have in my mind, and it's making me really rethink my portfolio, is that I'm starting to see more than one company come out with earnings, miss the number, and talk about supply chain issues. We know these issues have been here for a while, and yet they're starting to come home to roost. And so I want to look at my portfolio and determine, I want to get on the right side of that supply chain problem. I want to own stocks that benefit from shortages, not companies that are hampered by the shortages, right? So perfect example. I want to own the shipping stock. I don't want to own the company that has to get product shipped, right? So as an example, we own shares of Zim. Okay, we added that this week. Okay, so just taking a look at Zim. All right, Zim's my favorite name in the space. I think this is the best management team, and they've set up their business right, and it's just popped above the 50-day moving average. The stock hasn't taken off yet. That's the buy point right there. Okay, but that's just an example of what I mean. I want to own the shipping stock, not the company who can't get product. Okay, Levi's is an exception. You listen to the conference call and they tell you what they're doing. I'll own that stock. Okay. All right. So there's a lot of shortages out there. Shortages of energy, shortages of supplies, materials. This is why we have a supply chain issue that's lingering. So we already have precious metals in the portfolio, okay? You all know that we've got our gold and our silver in the portfolio. And I don't like to talk about these things too much, during the trading session because, an update doesn't mean anything. I need to see where this thing's going to close. Ideally, gold would close. This is Sprott Physical. I'd like to see it close above the 200-day moving average. That would be ideal. It doesn't have to. But let's look at the weekly charts now. Look at the weekly chart of Sprott Physical Gold. Now, I don't know what it's going to do tomorrow. I don't have a crystal ball. But if you want to look at an obvious entry point, if you want to be early, right now, if you'd rather pay $15 for it as gold is blowing out, then be my guest, man. I'd love for you to bid my position up. Please do that when gold breaks out. Run after it, chase it, drive my position higher. Thanks very much. But what we try to do is buy tight to the base, close to the stop. Okay? And then when it moves, we just enjoy the benefit, the fruits of our labor, if you will. So we look at gold and silver. At some point, these things are going to reflect the shortages. Look at the bottom we just picked off last week. We added these things last week, so we're enjoying the run this week. In precious metals, right off the bottom. And so it makes me really want to, and of course, round it out, we own some shares of I'm just showing you the weekly charts now of silver stocks and of precious metals, gold stocks, right? Three up weeks in a row, bang, 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 trying to break out of this downtrend. Okay. So they had a really great week, and hopefully they'll follow through next week and break out of the downtrend completely, and then we'll really know it's game on. And so to get back to my conversation with you, when I look at these earnings numbers and I hear what's going on in the supply chain and these issues, and we know inflation is getting hot, it really makes me want to own more materials. And we already have something like 30% of our portfolio, somewhere around there, long commodities. I'm going to lean into that. I might get to 40% commodities. Okay. And I think one of the ways I'm going to do it is by adding shares of the ETF XME. It's just an easy, safe way to do this. There's steel in this. There's uranium in this. There's coal in this. There's more precious metals in this. There's copper in this. There's everything in this ETFs. So let's talk for a second about an ETF investing versus stock investing. 2021 has become, to me, fairly clearly an index market. The reward to risk right now is in owning the indexes and in ETFs of groups. Reward to risk, the optimal reward to risk. What I mean is, last year, the reward when you bought an individual stock was enormous. The stocks went berserk, okay? And there wasn't a lot of risk on downside. It just seemed like everything was running. So you didn't have a lot of risk, and the reward was huge. This year, there have been individual stock blowups all year long. I mean, things that you thought were money just imploded. SNAP is the most recent example. So when it comes to earnings season and these things, the reward to risk is like turned on its head. The risk is ugly. They get crushed. The reward, I'm not seeing any big upside. So you might go through a day like today and the volatility on the portfolio may be really more than it should be because of overexposure to individual stocks in a market that keeps grinding higher. It's an index market. It's a group market. So when the Fed is tapering, removing liquidity, we'll get to that in a minute, raising interest rates, we're going to talk about that in a second, okay, by looking at utilities. But if the Fed's doing that, it makes it a much more treacherous environment. So if we're going to put money to work, we want to worry more about protecting the capital than capturing the upside, right? So I tried putting some capital to work this week in individual names. Then there's a blow up in SNAP. And I say to myself, you know what? It's risk monitor green. I want to get paid on this risk monitor green signal. And I don't want to step on landmines. So going into earnings the next couple of weeks, the risk reward doesn't make sense to me. I'd rather own groups. So that's why I say, should I go buy the steel stocks? I could. They look great. Okay. And they just announced earnings. So earnings are out of the way. You could own some, Nucor, STLD, Steel Dynamics looks reasonable, right? Certainly Cleveland Cliffs today was just a blowout quarter. What a great job they're doing. Okay. That looks like a stock could be owned. But what I would rather do, and I'll let you look at that while I'm talking, what I'd rather do is own XME, which is going to own the steels, give me more exposure to the right side of the commodity, supply chain issues without adding individual risk. That's my personal opinion. I'm just sharing with you what makes me comfortable. If you're comfortable taking more risk, have at it. Don't have to do what I'm doing. I'm just sharing with you what I'm comfortable with. That's where I'm headed if I'm increasing exposure. Now let's get to, real quick, this idea that the Fed's going to taper. I'll believe it when I see it. I'll believe it when I see it. And an ARMR insider, Saber, brought up a great a point that's worth talking about. If the Fed is about to taper, why are utilities doing this? Why? Why aren't utilities breaking down? Oh, they sold off. Now they bounced right up. They're paying the fat dividend. They're out of that. I mean, they're just not showing any signs of imploding. Hey, I got another thought for you. Fed just said they're going to taper. Why are treasuries not going lower? Treasuries made a higher low. Why? I submit to you the answer is the street won't believe it till they see it. And I think perhaps the problems that we're seeing on the supply side, supply chain and labor issues, okay, may force the Fed's hand, and they may not taper as fast as people think. They're going to be done by the second half of next year, was the comment today. Okay, how do we know when they're going to start? Maybe they start April next year for all I know, and they just keep saying taper, 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 and they finally do it next year. I don't know. Nobody knows. So what we do is look to the bond market to see, what does the bond market think? The bond market and utilities don't think the Fed's tapering anytime soon. And this is the reason why the stock market gives us a risk-on green signal and trades higher, in my opinion. All right, so what I want to try to do is capture the upside of this risk-on signal, but limit my risk. I can do it by buying ETFs, not individual stocks. I could do it by leaning into companies that benefit from the macroeconomic issues that are a problem right now. And I can do it by day trading, okay? So let's just go to the videotape real quick and look at our day trade from today. This is a long position on the S&P. Okay, so the ideal way to day trade, and what I'm considering doing with my own personal capital here. So I run portfolios. I have my ARMR portfolio set up for all you guys. You can see the spreadsheet, what stocks we buy, what the stops are, and all that. And I'm not going to just arbitrarily change that spreadsheet, because not everybody likes to day trade. So I think there's more risk in holding a whole portfolio overnight than there is day trading, okay? There's just, to me, less risk. If you know how to day trade, there's less risk. You're trading the indexes and your cash at the end of the day. So you're carrying cash overnight, but then you're putting the capital to work each day when you get opportunities. I'm going to show you the opportunity in a second. You're going to see it. Jeffrey Gunlock, somebody I really respect, was on the news wires today saying everybody should carry somewhere between 12.5 and maybe 20% cash in their portfolio at this stage in the cycle. I totally agree with them. I want to carry that overnight, and then I want to put that cash to work each day, day trading the indexes to capture upside. Okay? So here's how we do it. We wait for a crazy Ivan. Now, those of you who know the Hunt for Red October, you already know this story. I'll try to keep this brief. But a crazy Ivan, just from the movie The Hunt for Red October, it's a submarine story, right? There's a Russian sub, there's a U.S. sub. The U.S. is behind the Russian sub. And then like every hour or on the hour, the Russian sub just turns around, does a 360 to see if anybody's behind him. So the market does a 360, right? It just turns around and implodes for an hour for a reason that gets revealed to us near the end of that hour. Okay? It's a crazy Ivan because then the market just turns right around and goes back on the course that it was going on. It's just a shakeout, okay? And it's that shakeout that we use with spot gamma levels that really supercharge the trading process. So let me show you what I mean. So the market peaks right here on that median bar reversal. Remember that, guys? We talked about it on the live trading desk this morning. And I said, hey, there's a median bar reversal. I mean, that was just a no-brainer reversal right there. I had a trade on early this morning on the S&P, and I really should have taken it off immediately on that reversal because it's such a clean and obvious 2-bar median bar reversal. But anyway, my stop was underneath here and I ended up taking it out here. Okay. I took it out right around here. The market imploded. So let's just get back to crazy Ivan trading. You come in each day and you have, let's say 100% cash in a day trading account. You don't do anything until you get the crazy Ivan sell-off that lasts for about an hour. My favorite crazy Ivans happen between 10:30 and 11:30, which is exactly what happened here. I mean, it could go a little bit over 11:30. It has to be at least an hour, right? So this one bottomed somewhere around 11:45. This is money. I can't tell you how many times I've made money on this trade. It's obscene, really. If I just waited all year and only traded these and did nothing else except for, sit in a hammock and watch the ocean while I waited for this trade, I'd be a much happier person. I don't know. But I mean, this trade comes through. It happens all the time and it's money every single time. So anyway, it comes right down to a key gamma level, which is this purple dashed line here. And then we get our trigger, right? The buy trigger. You can see it prints those 2 yellow bars right there. Bang, bang. It's actually a 3-bar reversal and the 2 yellow bars tell you that it's on, game on, okay? So what I did was I actually preempted the 2 bars. I was buying it right here off of that reversal bottom and then finished the position off on the second yellow bar. So my average price was in here somewhere, right? And then it trades right back to and through the gamma level. And I just took my position off right in here because for me, I stayed with it right on through this gamma. It popped above the gamma. It put in volume above the gamma and then reversed back below the first standard deviation above the VWAP. And to me, that's a time to get out of the trade. I'm just done trading. I just picked off the whole thing. It's the volume spikes that get me to do it. Just like the volume spikes on the downside tell me a reversal up is coming, volume spikes on the upside often tell me the reversal down is coming. That's exactly what happened. Okay, so to wrap up this thought, what I'm going to be doing, I'm in my personal portfolio now, not for everybody to do, is what I'm doing personally. I think I've said it enough, but I'll keep saying it. Just make sure we all understand we're all on the same page. Okay. I want to carry a certain amount of cash overnight. I'm not 100% comfortable with the market. I want to reduce my individual stock holdings in the portfolio and increase ETF groups because I still think we got upside in here. Okay. But I want to focus on indexes, focus on groups, focus on companies that have already announced earnings so I don't walk into a buzzsaw. Okay. This is how I want to set up my portfolio. And I'm going to be day trading these setups all day long. Yesterday, we were short and then long. We made money in both directions. Today, it was just the long trade we made money on. But every day, these index trades show up. And I like to use the triple ETFs, SPXL and TQQQ on the long side, and then TZA, which is the short side of small caps, to make my trades. But you could use puts and calls, or you could just use the regular indexes. Depends on how you like to trade. Okay. So those are my thoughts for today. Here are some ideas that are at the top of my whiteboard. The XME I'm adding, I have an interest, in Deere because I really believe there's a super cycle coming for Deere and Caterpillar, but I'm not putting that trade on right now. I really have an interest in increasing my position size in this rare earth MP, but I also want to increase position sizes in precious metals. I might do that. I might increase my position size in the copper ETF, which we own the COPX. I might on weakness, but I'm not doing that right now. These are just some thoughts off the top of my head of what I may be doing. And then my question really for myself is, do I want to create an insurance part of my portfolio? And I'm not going to do that today at the close, but I might work on that next week. Travelers, AIG, do I need more financials in the portfolio? That's a question. Of course, these names don't care about, supply chain issues. They don't have any, if anything, they benefit from inflation issues. So Chubb, these are the names that we really want to focus on. I'd like to get them in the portfolio, but I'm not going to add them as they're running. Now, let me just answer a question for those of you in the ferns. You know who you are back there in the back of the room. The question was, I'm looking for a double bottom higher low setup, in cannabis. So let's look at cannabis for a second and see if that's happening and how it would happen. So first of all, we added some cannabis on that big up bar, and we're using the low of that bar as the stop. So I'm not going to sell them out just because they're having a terrible day. We expected them to have a terrible day, right? They're in a massive downtrend. So when you're buying a big downtrend, if you're buying early, you identify the entry point, you identify a stop, and then you have to let it play out, okay? So what would make this a higher low? And let's look at CGC. Same story here. Okay, Telray. Okay. So let's just go to MSOS because that's my favorite. And the definition of a higher low to me, how do I know when it's complete is the question. How do I know it's complete? So you have this up bar here. So there's your low that's set. Then you're coming back down to test it, right? What would tell me that a higher low is in is if this price closes above the high of this move. So here's the up bar and here's the high of the move the following day, 2 days later, right? And then it reversed and it's selling off today. If on Monday the thing blew out here and closed above this high, I would say, hey, the high that made a higher low. It made a higher low. So the answer to your question that you asked, you answered your own question when you asked it to me. You're correct. We have to see the asset close above the high, and then you can look back at the low and say, hey, was there a higher low? That's how we know that's happened. Okay? Does that make sense? So it's not happening right. I mean, today's a down day. The markets are, having issues, and so they're selling off cannabis today. But I'm not touching that position. When I took that position, I said, I'm going to give it to the low of the big reversal day, see if that reversal day holds. Takes out the low, I'll be out. I don't want to overtrade it just because I had a down day. Okay? We didn't take a position that was too big. It was a starter position. And because we've avoided the entire decline that you see right in here, this whole decline we've avoided, we have the right to take a little bit of risk down here. And so we're putting a little position on, see how it feels, see if we can make some money. And if it has a reversal day next week and takes out the highs and puts in a double bottom, boom, we double our position because now we know maybe it's game on and there's a change of trend happening. Okay? So that's how I'm going to trade that. All right. Any questions, guys? It's 3:30. I need to get to setting up the portfolio for the end of the day. Any changes I have to make. So any questions you've got, I'll take questions, and then I've got a split. Anything you got for me? No? Are we good? Great. All right. So ARMR Insiders, I'm going to update the portfolio page at 3:45, and And then I will see you all on Monday because I won't be on the desk tomorrow. Okay. Take care, everybody. Have a great night and a great weekend. All right. Take care.